Are you looking for a reliable way to earn passive income every month? Dividend ETFs are a popular choice, but not all of them are created equal. Today, we're comparing two of the hottest income-generating ETFs from JPMorgan, JEPQ and JEPI. Both promise high monthly payouts, but which one truly delivers better passive income? If you're serious about maximizing cash flow, choosing the right ETF can mean the difference between consistent earnings and missed opportunities. In this video, we'll break down JEPQ versus JEPI, analyze their dividend yields, performance, risks, and strategies, and help you decide which one deserves a place in your portfolio. Stick around, because by the end, you'll know exactly which ETF aligns best with your financial goals. What is JEPQ, JPQ, or the JPMorgan Nasdaq Equity Premium Income ETF is designed for investors who want income but also exposure to the tech-heavy Nasdaq 100. This ETF holds large-cap growth stocks like Apple, Microsoft, and Nvidia while implementing a covered call strategy to generate additional income. The goal? Reduce volatility while paying high monthly dividends. JPQ's biggest appeal is its high yield. As of January 31st, 2025, JPQ's dividend yield is approximately 9.81%. That's significantly higher than most traditional dividend ETFs. But with higher returns often comes higher risk. Since JPQ is linked to Nasdaq 100 stocks, it can be more volatile compared to ETFs that track the broader market. What is JEPI? JEPI, or the JPMorgan Equity Premium Income ETF, takes a different approach. Instead of focusing on tech-heavy Nasdaq stocks, JEPI invests in the S&P 500 and generates income using a similar covered call strategy. Because of this, it tends to have lower volatility than JPQ. As of January 31st, 2025, JEPI offers a dividend yield of around 7.24%. While that's lower than JEPQ, JEPI provides a more diversified portfolio, reducing risk exposure. This makes it attractive for investors who prefer stability over chasing the highest yield. Which pays more? If your goal is to maximize monthly income, JEPQ has a clear advantage. Over the past year, JEPQ's total return was 24.89%, while JEPI delivered 12.58%. However, higher total return doesn't always mean better long-term results, especially if market conditions change. Let's put this into perspective. If you invested $10,000 in JEPQ a year ago, your total return would be around $12,489 today. With JEPI, that same investment would have grown to $11,258. While JEPQ delivers higher returns, it comes with more exposure to the high volatility Nasdaq 100. Another important consideration is how these ETFs perform in different market environments. Historically, during strong bull markets, JEPQ tends to outperform because of its Nasdaq 100 exposure. However, in bear markets or economic downturns, JEPI's broader diversification and lower volatility help it hold up better. Investors should consider where we are in the market cycle before choosing between these funds. Now, we will try to understand covered calls and how do these ETFs make money. Both JEPQ and JEPI sell covered call options to generate extra income. This means they collect option premiums in exchange for limiting some potential upside in their stock holdings. The trade-off? Investors receive steady income but may miss out on larger price gains in bull markets. JEPI has a more conservative approach, selling calls on up to 20% of its portfolio, keeping the rest open for growth. JEPQ, on the other hand, writes options on a larger portion of its portfolio, which increases income but can cap gains when the Nasdaq surges. This is why JEPI is often considered safer in a bear market, while JEPQ thrives when tech stocks rally. To illustrate, if the Nasdaq 100 experiences a 20% rally, JEPQ may underperform a standard Nasdaq ETF because its gains are partially capped due to the covered call strategy. However, if the market is flat or declining, JEPQ can outperform by generating income from option premiums, cushioning losses. Risk considerations is another important factor as it helps us to understand which ETF is safer. Risk tolerance plays a key role when choosing between JEPQ and JEPI. GPQ's heavy allocation to NASDAQ 100 stocks means it's more volatile, especially during tech sell-offs. JEPI, being linked to the broader S&P 500, offers a more balanced and diversified portfolio, making it a better choice for conservative investors. For example, in the 2022 bear market, JEPI outperformed JEPQ because tech stocks took a massive hit. However, during the 2023 to 2024 market recovery, JEPQ's growth-oriented holdings helped it outperform JEPI significantly. This highlights how market conditions can influence which ETF performs better at any given time. Tax implications is a crucial factor which investors need to know. Both JEPQ and JEPI generate income primarily through option premiums, which are usually taxed as ordinary income rather than the lower capital gains tax rate. This means investors in high tax brackets could see a larger portion of their earnings go to taxes. For tax-efficient investing, some investors prefer holding these ETFs in tax-advantaged accounts like an IRA or 401k to avoid heavy tax burdens on dividends. Finally, which one should you choose? Both JEPQ and JEPI offer great passive income opportunities, but the choice depends on your risk appetite. If you're comfortable with higher volatility in exchange for higher dividends and potential growth, JEPQ could be the better option. But if you prefer stability and consistent income, JEPI might be the smarter choice. Ultimately, there's no one-size-fits-all ETF. Some investors even hold both JEPQ and JEPI to balance growth and stability. If you're uncertain, consider diversifying with both funds to get the best of both worlds. So, what's your strategy? Do you prefer GPQ's higher yield and growth potential or JEPI's stability and steady payouts? Let us know in the comments and subscribe to our channel Finance Flowchart for more videos.